Good afternoon and welcome to PincusCo Live, the weekly New York City commercial real estate broadcast. Thank you for joining us for our 8th episode. Prior episodes are on our YouTube channel and via podcast. Today we're speaking with Scott Barone and Stephen Preuss about the impact of rising interest rates on commercial real estate deal making in London. Scott's the founder and principal of Barone Management. Launched in 1999, the company was initially focused on property management and small to medium-sized fee-based construction management before expanding into development and consulting as well. More recently, in 2018, Scott led his firm's foray into the niche charter school development sector. Stephen joined the brokerage RIPCO Real Estate in 2021 as one of the top producing investment sales brokers in Queens and one of the highest capital markets producers in New York City. Over his nearly 20-year career, Stephen has done over $5.2 billion of commercial real estate transactions. I'm Adam Pincus, founder of the 3-year-old news and data publishing company PincusCo Media. We distribute newsletters on transactions and new development and sell our proprietary data. This episode is sponsored by G-Parency. It's a provider of technology solutions designed to empower commercial property owners and reduce their reliance on certain high-cost service providers. Before we start, I'd like to let our viewers know we'll be speaking next week with developer Sharif El Gamal, founder of Soho Properties. Watch for an invite tomorrow. So Scott, thank you for being here, and I'd like to start with you. I took a look at the 10-year treasury rates over the past 10 years. Today, they're around 3%. That's up from less than 1% in 2020. What does that mean? And describe where commercial lending is today from your perspective as a borrower.
Short answer to that question is up. All right, and you don't need to be a real estate professional to know that. You need to have access to any one of the front covers of a legitimate newspaper. It's solidly up anywhere from a half to 3/4 of a basis point over the course of the last couple of months alone, and it's having a significant and meaningful impact on not just real estate specifically, but every aspect of every business that we can see. We have a host of tenants throughout all of our commercial properties, and their cost and access to capital is becoming more challenging.
And how does that compare to a couple over the decades? Like we had been in a low interest rate environment for years. And so what's the sudden change? What's happening? Stephen, I maybe talk about that.
Sure. So we're in the midst of it now. So we've seen 200 basis point jump relatively overnight over the last few months. So we're digging through a lot of these transactions now. And seeing what the effect is on pricing, on buyer's perspective, seller's perspective, what the lender factors in as far as those options go. So, overall, we're in the midst of a resetting of values based upon this rising interest rate economy. And we've been through 4 or 5 years of talks that interest rates are going to raise. It will happen, but it never really happened. So we got into a mindset where, whether we wanted to acknowledge it or not, that everyone took it for granted that, we were going to have 2 and 3% rates going forward. It did not rise year after year. And people were, placing capital and looking to transact. But I think they were taking a little bit of a conservative approach over the last couple of years with the pandemic. On placing that capital, when now looking back where we are today, they probably should have been a little bit more aggressive on deploying that capital. So we're in a unique position right now, and it's almost counterintuitive where speaking on the investment sales side, you have a rising interest rate economy. These people who have raised most of these groups, and institutional or otherwise, historic amounts of capital. There's more dry powder in today's world than I've ever seen in 20 years by a long shot. So you see a lot of those people now realizing they have to be more aggressive on deploying that capital out to the marketplace. So even though we're getting pressure on cap rates and any other metric that you want to place against the higher lending costs, we're seeing an enormous amount of deal activity because they want to get that capital out now while rates are 4.5, 5, as opposed to where it will be in 6 months to a year, which could be 6 or 7. So we're in a kind of counterintuitive, very unique apex of the marketplace where people are trying to push that capital out, trying to lock into rates now, where they were taking a little bit more of a complacent approach over the last few years.
And Scott, what are some of the different kinds of buy? What's the impact been on the buyer pool, or on your ability to buy?
It's definitely more challenging. Your cost of capital is up, and it's your most important part of your capital. Your equity, whether it's checks from your own account or investor capital, that's sort of staying right here. But your most important part of your stack is your debt. Old rule is best partner to have is a bank. So whether you're at 60, 65, 75% leverage, whatever, depending on what type of borrower you are and what type of asset it is, as that comes up, your ability to pay is coming down. All right, it's like I've always said, it's like a water balloon. You squeeze it at one end, it swells at the other. It's a zero-sum game. All right, especially with a lot of challenges that are still in the market as a result of COVID. Plus, inflation is a rule. In the real estate business, for the most part, we are in the business of other people's businesses. And as their businesses are impacted by inflation, by supply chain issues, by manpower shortages and stuff like that, their ability to pay rent, let's say on a commercial asset, we're in the process of leasing up a large commercial industrial and office building in Long Island City. We've done far better than I ever thought we were going to, through COVID. We started leasing, it had to be, 3 to 4 months, maybe 6 months after COVID. And we've been able to achieve really strong rents, but we're holding our line. It's just taken us a long time to fill because people coming out of, an older industrial building that want to go into a brand new industrial building are going to be less cavalier with what they're willing to pay for rent.
And how, do you see that? Can you give an example? Like someone was like, okay, I don't know where you rent the $35, I don't know where they are, but do you have to actually come down because they're like, look, the rates went up and our costs of money just went up?
Thankfully, we built the right building the right way. That particular building is, best in class for the market. We're the first spec ground up industrial and office in Long Island City. And over 30 years, we're achieving numbers that are solidly north of 40, but we're holding our line. So we're taking longer to fill it than we would have liked, is sort of the approach to it.
And Scott, I'm sorry, Stephen, can you talk about different kinds of buyers who are coming in now and why?
Sure. So it's really what we're seeing mostly in, let's call it the middle markets. We're seeing a resurgence of the generational buyers, family offices, people that have been around for a long time, but may necessarily not have been at the top of the trades transfers over the last few years. These are guys I used to deal with and girls I used to deal with, 10, 15 years ago. They may own 10, 15, 20 buildings in a certain neighborhood, and they were completely priced out or weren't comfortable with the pricing over the last cycle, where you see really an influx of syndicators, new capital, people pricing to perfection, using pro formas that were, at light at best, overpaying, whatever the case may be. Now we're seeing the market settle. We've seen pricing for the most part and most asset classes reset. So we're seeing those generational buyers who don't have a 3 or 5, 7 year horizon, like a lot of these institutional buyers, which is very difficult in New York City right now to buy on any sort of a shortened timetable. We're seeing these groups come back in and they're able to pay 15% less, 30% less than where the market was a few years ago. And they're not competing against 40 or 50 buyers. So we're seeing a real resurgence of the long-time owner who are looking at it.
Why are they not competing with the dry powder with all the institutional guys? Is it a smaller dollar
These groups are flying a little bit more under the radar, right?
Mhm.
So these are, the 50 million and under type buyers. And also it's their own capital. So a lot of the institutional buyers and a lot of the larger equity buyers, they still have a board, they still have investors that they have to explain a certain neighborhood in the outer boroughs, or really try to talk through some of the risk. And by the time that they get smart on the property or that area and looking to place an offer, the generational buyer, it's their capital. They have a relationship lender that can move quickly. So by the time that they get to a point 2 or 3 months into marketing a property, a generational buyer will be under contract and closing in 30 days. And there's not as many syndicators or people running around with OPM, other people's money in today's world. So it's not so much as new buyers to the market, it's really the resurgence and recycling of the longtime owners of a certain neighborhood, generational buyers, small family offices, and their mindset is my kid's going to handle it, my grandkids are going to handle it. As far as the pro formaing out a 10-year turnaround and resale, that's not something that, typically that they'll do. They'll look at it saying, I'm going to own it forever. So it's really a time for those types of buyers to make their imprint on the market again.
Do you have some examples just of that?
Sure. I mean, we were selling 100-unit multifamily building in the greater Jamaica area, where something like that, 75% of the bidders would have been larger, either equity, larger institutional, larger equity buyers. We ended up selling it to somebody who has, 18 similar buildings in that neighborhood. And 90% of the bidders during that process, we had about 15 bids, were all, I don't want to say smaller, but under the radar, the neighborhood buyers. So, that's one example. The development sites that we're selling now, they're selling to, some of the neighborhood buyers where, back in the day, we used to sell a Long Island City development site from a Long Island City seller to a Long Island City buyer. Then we went through a period of 5 to 7 years where, we've seen, everyone from the other side of the river come in and buy a piece of Long Island City. Now we're seeing those buyers recycle. We just sold a $4 million piece there. It was sold to one of the neighbors that you never heard of before, but they have 4 developments on the block. So, those are the type of examples that we're seeing on a regular basis right now. For that, I want to call it that 50 million and under type of product.
And Scott, can you talk about maybe who you're competing against, like deals that you went into and you didn't get, and then deals you did get, if you know who the other buyers were?
We've had with a few exceptional brokerage relationships, Stephen being one of them. I'm typically an off-market buyer. We don't see a lot of competition, and we tend to buy more specialized asset class. I'm not a multifamily guy. I'm not the guy that, buys an apartment building at a 7.5 cap, clean it up, and look to either refinance it or sell it at a 5.5 cap. We're much more commercial, specifically over the course, although not exclusively, over the course of the last 4 or 5 years. We've been very, very active in the charter school sector. Which gives us certain strategic advantages. We're able to make a lot more use of community facility than most people are, because it's actually our primary goal, as opposed to, okay, I'm going to hopefully rent to an urgent care at the base of my mixed use, multifamily residential building. So we haven't seen a ton of what I'll call competition. And, as one of the types of buyers, although I'm first generation myself, I consider myself a generational buyer. We have been very, very, very active as things have started to dip and slow. I mean, I haven't bought anything in the Bronx throughout my entire career. In the course of the second quarter that we're in right now, we've acquired or are about to acquire a combined total of 7 sites in the Bronx. We're a total of about 250,000 feet.
So all different, separate, different sites.
Yeah, 1, 2, 3 will be charter schools. 2 will be daycare. So basically not city funded, but daycare voucher programs type stuff. and 2 will be ground up supportive veterans housing.
And is any of that have to do with the interest rate, or that was, you were just active over the past year looking for sites?
No, just means that we just happen to hit a particular run and really not tied to interest rates. The only thing that is affected there by interest rates is I'm paying more for my loans, unfortunately. So I'm going to make a little bit less than I would have liked. But
I think that's an important point going to competitive advantage, is that Scott has a unique ability to fill some of the other asset classes outside of residential. So residential development land has been a big part of my business. You know, I've sold over 10 million square feet over the last cycle alone in the outer boroughs. But right now, you see a lot of people stepping back from residential, especially the rental marketplace, with the expiration of the 421A looming. So the highest and best value right now, and some of the land, and Scott can correct me if I'm wrong, but some of the land that he really never had a shot at because he would have to compete against residential developers that were paying 200, 300, 400 in some cases on a price per buildable, you know, for rentals, they are now gone because no one's going to take the inherent risk of buying a piece of land and hoping that Albany can get their things in order to come out with a new replacement for the 421A. So when you take that residential component out, there's now what's left is someone trying to buy that residential component at a 50% basis to mitigate any cost or lower cost of land and value. Now Scott can step in and make use of that land for other different types of uses, whether it's some other type of community facility that's in his portfolio, one of these charter schools, which he's able to be competitive on and pretty much outprice what residential buyers are willing to pay right now. So this is a great opportunity, I think, for his development organization and similar developers to step in who are creative, that can move quickly, that it's their own capital, and can really find a lot of opportunity in today's world in New York City, where, you know, opportunity in New York City have not been, you know, used together very often over the last few years.
Can you give other examples? What are some other types of buyers other types of developers that are coming in that are not doing resi, other than schools?
All different types of community facility uses, from medical to schools, whether it be charter or otherwise. It's really filling that community facility or that CF space that we're seeing people come in, and a lot of users. So a lot of the users that were also, you know, that maybe don't have a development partner like Scott there, like somebody wants to use, you know, 100,000 square foot for their own medical facility or for their own business. There's no way that they would be able to compete against these residential developers. So you have Scott and his great roster of different and unique type of tenants, but you also have users that are coming in and saying, listen, I can pay a competitive pricing, maybe not what land used to be worth on a residential land, but I can pay it more for what a residential developer would pay for it in today's world. So we have a lot of users, you know, really stepping up and making competitive offers as well. And looking at this economy and this cycle of real estate in New York City as an opportunity.
And what are different ways people are structuring, looking back at the idea of interest rates rising, are people structuring deals in different ways? Scott, are you guys doing anything different?
Yeah, you know, we've been looking at more sort of creative usage in order to get our own capital to work better. So essentially, you know, right now we're looking at one deal where we're in the process of refinancing a construction loan into a permanent loan, and we've decided that we're going to actually increase our debt profile there by bringing in some preferred equity. We know that we've got, you know, a solid cash flowing asset in place, but it's going to take us a little longer to get it to full stabilization. So that makes sense on stuff like that. I think you're going to see out of the box stuff as, you know, as rates come up, let's say on traditional bank financing, as Stephen referenced earlier, where you have the institutional money players out there, and not even at the scale of, you know, Blackstone. I'm talking, you know, mid-level private equity funds and shops that, you know, typically we're putting money out before it, you know, 14 or 15%. To a certain extent, you're almost seeing them come down on their rates a little bit because they're worried about getting money to put to work. You know, I always like to say, you know, everybody talks about institutional money. Well, those Those institutions are made up of people. They're made up of bankers. They're made up of guys that are out there selling loans. And if they don't put that money to work, there ain't going to be a year-end bonus there. There ain't going to be production. They're going to be doing the one thing that in the institutional money business is the worst thing you could ever do. You're going to be going back to your investors and saying, I'm sorry, I don't have anywhere to put your money.
Right. I think that tees in nicely, with the alternative transactions that we're seeing right now. So whether it be interest rates and more so the resetting of values, and right now, I guess that runs in tandem, but we have reset values from the peak of the market, which I think largely was around 2017, depending on which asset class we're talking about. But generally speaking, people are looking to transact in different ways. You have a lot of sellers, and I deal with a lot of out-of-borough owners who have owned it for 30, 40, 50 years. And their ultimate plan at some point in time was to sell out at the peak of the market and then transition into Florida or one of these better tax states on a nice 8 cap triple net, with a Wendy's for 30 years. So they missed the market, right? So over the last few years, you've seen just a rush on assets in these secondary states, which are really now the primary states, I guess, where now if they were to sell and go into those markets, it's highly competitive, much more expensive than New York City in a lot of these asset classes, and it's very difficult to find. So now people are looking at their their portfolio and their estate planning and saying, listen, if I can't do that, I really don't want to have to be put under the gun as far as the time limit goes, and me, get something subpar in Charleston, South Carolina. What else can I do? So people are looking at alternative and creative structures to be able to transact. And in the last 2 years, we've done more ground leases, joint ventures, development partnerships in the last 2 years than I've done in the last 20 years. And I know that's—
give some numbers, just to, it didn't double from 2 to 4. Some idea of how many deals.
We've done several dozen, and right now I think we have
ground leases, or
not only ground leases, but joint ventures where maybe they've owned the land and they're looking to contribute the land into a development partnership, and the developer will take on that development project and bring in the financing, the development expertise, guarantees on the loan, completion guarantees, the equity needed to fund all the development. And that's a way for a long-term owner to stay with premium New York City real estate and to be able to benefit from a brand new mixed-use building or something along those lines. Well, they'll have income. They'll be able to build on their land and have income for generations to come, and not have to sell, not to have any tax liabilities at the time of the transaction. And there's really no tax liability until they actually pulling income. So at that point in time, it makes a lot more sense for them on a tax or estate purposes, or if pricing is just off. So we have a $150 million development site in Northern Queens right now, where the pricing in today's world is probably $100 million. But the pricing a few years ago was $150 million. So we were able to get him a $150 million valuation, but it's through a joint venture development partnership, which he's taking back some preferred equity. And when you stack all of that up, he's getting his valuation at that $150 million that he probably will not see again for the next decade or so in New York City, or maybe ever again. So getting creative, doing different types of structures, there's a lot of benefits to that. And I know that Scott has done probably more ground leases than any other client that I have.
Yeah, ground leases. Listen, when I was a general contractor, I fell backwards into my first development deal in 2008. All right, it was actually a building we were supposed to build for somebody else, wound up acquiring it under a ground lease after, Lehman went off the edge. I didn't know what a ground lease was. And since we've done, I want to say it's almost 25 at this point, both on the side of ground lessor and ground lessee. As an example, the stuff I was talking about earlier in the Bronx, of the 7 sites we're acquiring right now, 5 of them are ground leases. All right, it is a huge proliferation of that going on. And, thankfully, we were able to establish a niche and a real reputation early in where, when I did that first deal in 2008, and Stephen can tell you, he's been at it a long time as well. A ground lease was an oddball. It was 2, 3, 4, maybe 5% of the transactions you saw. Where it is, because we've been able to execute on them, we get a lot of phone calls that we didn't used to get. And, the real risk of a ground lease on the part of the ground lessor, your fee owner, is you need to make sure that you're, for lack of a better phrase, in bed with somebody that's going to be able to transact. You need to not just know how the ground lease works on both sides of the table. You've got to make sure that you can get financing on a ground lease, and you got to have execution ability. I can take somebody who owns a piece of fee, who would have considered selling the asset, now wants to stay in it long term. I can walk them to 20 buildings where there's a building sitting there under a 99-year ground lease where we execute. And it's also the lending relationships. I mean, if there are, whatever, pick a number, 100 construction lenders in the city of New York that'll do ground up construction, that number narrows to about 20 that'll actually do ground leases. All right. And then as you start to, put more nuanced deals into that, okay, if there are 20 lenders that'll do ground leases in New York City, well, okay, it's a ground lease that's not multifamily residential. Well, the number becomes 10. All right. And there's probably, candidly, and I don't like to toot my own horn, there's probably only maybe 25 or 30 guys in this city that can execute and actually develop successfully on the ground leases the way that we've been able to do. And it's just for a decade or more of doing it over and over and over again, you get to learn where the strengths are and where the weaknesses are.
What are some of the risks? Like what goes sideways on a ground lease? Like, you gonna fight? I mean, how does it? Once it's signed.
Lots, in my experience. I mean, listen, from the perspective of the fee owner, your real risk is the day in between you sign the ground lease and your tenant, your ground lessee, your developer, whatever you want to call them, puts a TCO on that building. Once there's a TCO on that building, risk is gone. In some instances, on some of the stuff we're doing right now, as an example, we're taking ground leases on existing buildings where we're adding bulk. But we've done them on deals where we had it, like that first ground lease deal we did down in Tribeca in 2008. We tore down a 25,000 square foot building to build a 90,000 square foot building. Well, that ground lessor wanted to be damn sure that we were going to be able to execute, because we were tearing down a 25,000 square foot building in Lower Manhattan. There was value there. We turned it into a hole in the ground. If I get hit by the proverbial crosstown bus somewhere in between hole in the ground and at least a nice piece of structure sitting in place, this guy just got signed up for a mess that he didn't really want to be a part of. That was not his intention. He didn't want to take development risk. He wanted to stabilize cash flow.
And Stephen, I mean, are you pitching mostly on the trying to get someone to sell? Do you go in and say, hey, let's just try it this other way? You're not going to get your number. Let's try the JV.
That's always an option. I mean, one thing I pride myself on is I'm probably one of the few brokers, especially in the outer boroughs, that we really dive into the complexities because we can handle it and we know how to structure it. We know how to sell it. So that's always something that we bring up, especially if they are hesitant on selling. And there's usually a few key things that if we hear that, we can pivot and put together some options. And it depends on their, on how savvy they are with real estate, right? So, if they're not savvy, they probably want to ground lease it. That's hands off, that's handing the keys off to somebody like Scott and, having his first-class development team, build a building, tenant it. If they're a little bit more of a savvy of a real estate person, maybe it's a joint venture where they actually participate in the overall transaction in some shape or form. And then it gets more complex from there, but it just seems to fit a lot of today's concerns, both on a tax basis and a New York City basis, on a value basis, to be able to fit more and more people's full needs and longer term needs, is to get into some of these alternate transactions as opposed to a disposition.
And I'd like to ask Scott's last word, like back to the interest rates, like where do you think it's going? Do you think they're going to keep going up? Like when you're planning, do they keep going up?
I mean, Steve said the last 4 or 5 years. I got to tell you, we did our first real estate deal, like I said, in 2008. And I remember saying back then, rates are low now. They're not going to be here forever. They're going to go up. They're going to go up. We've been saying that for 16 years, and now we're there. All right.
The last time we had 5% rates was 2008, Scott. So you're right on the money.
Right. So, you know, the reality of the world right now with everything that's going on, not just within New York City or New York State, we're talking countrywide, globally, I don't see anything on the horizon that is going to push rates down. So I think we're going to be here for a while until there is a meaningful sea change that causes, you know, in this country, the federal government to step in and take a little bit different of an action from what they've been taking over the last 12 months or so.
So, all right. Well, I want to thank you. I'm going to stop there. I'd like to thank our guests, Scott Barone and Stephen Preuss, and remind viewers to tune in next week when we're going to speak with Sharif El Gamal of Soho Properties. And thank you and have a great afternoon.
Thank you, Adam.
Thank you, Adam.
Thanks.